China's economy has been under the microscope recently, with signs of slowing growth, mounting debt, and even whispers of deflation. Given the challenges, many are asking the same question. Can China's economy rebound in 2024? The answer is not a simple yes or no. While there are significant hurdles ahead, there are also some unique strengths that China can leverage to recover faster than expected. And in this video, we are going to break down the challenges, opportunities, and the strategies that could see China bounce back this year. But before we continue, please consider subscribing to our channel to show your support. The challenges: deflation, debt, and a sluggish real estate market. The first major issue facing China is the early signs of deflation. When prices drop over an extended period, businesses earn less, and consumers start holding off on purchases, expecting prices to fall even further. This can create a vicious cycle of reduced spending and investment, which only worsens the economic slowdown. It's a situation China hasn't dealt with for decades, and if not addressed, it could drag the economy down further. Another key challenge is China's debt issue, particularly within local governments and the real estate sector. In recent years, local governments have piled up debt from funding ambitious infrastructure projects, which were previously seen as engines of growth. But with the economic slowdown, these projects have become a financial burden. Moreover, China's real estate sector, once booming, has been hit hard by high-profile debt crises like the collapse of Evergrande. With real estate making up nearly 30% of China's GDP, this sector's health is vital to the overall economy. Since last year, China's real estate market saw a dramatic downturn, with housing prices falling and sales stalling. Developers, strapped for cash, struggled to finish projects, leaving buyers uncertain and unwilling to invest. This has turned into a liquidity crisis, where there's plenty of money in the system, but it's not circulating quickly enough to keep the economy moving. So what can China do to reverse these trends? It's clear that simply cutting interest rates or relying on exports won't be enough this time. More drastic measures are needed. Opportunities: strong savings, policy flexibility, and the power of reforms. One of the major advantages China has over other economies in distress is its high savings rate. Chinese households save about 45% of their income, one of the highest rates in the world. This not only provides a financial buffer for individual families, but also puts the government in a stronger position to borrow and invest in measures to stimulate the economy. With ample state-owned assets and a manageable central government debt, China has the ability to take on more debt to fund recovery without immediately risking financial instability. Another opportunity lies in China's flexibility to implement strong fiscal and monetary policies. Unlike many Western countries, China's government can make and enforce economic decisions much more quickly. The government has already shown willingness to step in and stabilize sectors like real estate. One possible approach is to issue more government bonds and deploy funds toward infrastructure projects that can generate jobs and spur demand. China could also look at quantitative easing measures similar to those used in the US and Europe during the 2008 financial crisis. These policies help boost liquidity and lower interest rates, encouraging borrowing and investment. But perhaps the most crucial opportunity lies in the continuation of market-oriented reforms. For decades, China's economic growth has been fueled by a blend of state control and market dynamics. However, in recent years, many foreign businesses have felt that China is becoming less open and more unpredictable with regulations. By adopting policies that are more transparent and market-friendly, China can send a clear signal to both domestic and international investors that it is serious about fostering growth. For example, in 2020, China relaxed restrictions on foreign ownership in the financial sector, which led to companies like JP Morgan and Goldman Sachs expanding their operations in the country. Encouraging more of these kinds of reforms, especially in sectors like technology, services, and manufacturing, could draw in significant investment and create new growth engines for the economy. Can China achieve a 2024 rebound? So, what does the road to recovery actually look like? While China faces significant obstacles, it still has the potential for a strong rebound in 2024. The real key to success lies in its ability to leverage its savings, education, and market reforms to unlock new growth opportunities. Let's not forget that China's workforce is highly educated and increasingly tech-savvy. The country has made huge strides in industries like electric vehicles and renewable energy. For instance, in 2023, China accounted for 60% of global EV sales, outpacing every other country by a wide margin. This shows that China's push into high-tech industries is already paying off, and there's room to grow even more if the right incentives are put in place. China also has the potential to reform its private sector and encourage more domestic investment. Private enterprises often face hurdles due to tight regulations, but if the government can make it easier for these companies to access financing, expand, and innovate, it could significantly boost economic activity. The tech sector in particular has enormous growth potential, especially in fields like artificial intelligence, green energy, and semiconductors. Lastly, while geopolitical tensions, such as the ongoing trade war with the US, may impact China's pace of growth, they aren't the core issue driving the slowdown. In fact, since 2006, China has reduced its reliance on exports and foreign direct investment. Exports now account for just 20% of China's GDP, down from 36% in 2006. This indicates that China's economic health is increasingly dependent on its domestic market and policies rather than external factors. If China can continue its shift towards a consumer-driven economy, encouraging spending at home while also supporting innovation and tech industries, the country can still achieve growth that outpaces most other nations. In conclusion, while there's no doubt that China's economy is facing challenges in 2024, from deflation risks to a real estate slowdown, the country has the tools and resources to navigate this period successfully. By leveraging its high savings rate, accelerating market reforms, and adopting more aggressive fiscal and monetary policies, China can set itself up for a recovery. The world will be watching closely, but one thing is clear: China's economic story is far from over. If the government can get the right mix of policies in place, the country still holds significant potential for faster growth than many other nations, making a 2024 rebound not just possible, but likely. Do you agree with our analysis? Share your thoughts and leave your comments below. If you like what you watched, hit the like button and subscribe to this channel to show your support.